1986 was a crazy year. Space Shuttle Challenger exploded, Chernobyl melted down, serving as a metaphor for the Soviet Union as a whole. George O'Keeffe died, forever redefining how we think about art in the Southwest. Miami Vice was in the middle of its run, and we can't forget how unhinged the plots of 80s shows were. Crockett lived on a sailboat with an alligator named Elvis that ticks because he ate an alarm clock. But most importantly for today's conversation is what came out of Omaha that year. Warren Buffett famously told his followers in his 1986 shareholder letter. What we do know, however, is that occasional outbreaks of these two super contagious diseases, fear and greed, will forever occur in the investment community. The timing of these epidemics will be unpredictable. The market aberrations produced by them will be equally unpredictable, both as to duration and degree. Therefore, we never try to anticipate the arrival or departure of either disease. Our goal is more modest. We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. So this wisdom was given to us almost 40 years ago and has attained a near cult status in investment circles. The message we take away is that it's better to acquire an entity or an equity when it's undervalued and then to sell it perhaps when it's overvalued. When everyone's afraid and has abandoned this equity, you should hop in. Then when everyone's hopping on board and the price is going up, maybe it's time for you to get out. Seems plausible. It's certainly sensible. And there's no denying the underlying wisdom of the concept in driving our fundamental investing behavior. In a way, it's a reformulation of buy low and sell high, right? One of the problems with buying low and selling high is that we never really know when the low is low and the high is high, do we? And that might be a bit of the hint that Buffett was giving us here. Maybe we can watch other people's behavior and try to figure out when they're feeling greedy, in other words, when there's money to be made, and when they're feeling fearful. In other words, we might be hitting the high. A high is only the high because people collectively stop paying more, right? And the low is only the low because suddenly a critical mass of people decide that there is money to be made and start buying something. So maybe that's what Buffett's giving us here, are some tools to help decode the wisdom of the masses. Now let's bring it back to 2025. How do we know when people are fearful or greedy? Some people think one way is to measure the fear is the CBOE Volatility Index, VIX, which looks at options activity to get a handle on the bets people are making about the future, which is all this is the bets people are making about the future. Some people believe the put-call ratio is a good indicator of future faith. Mutual funds flow in or out of the markets, and that can be another great way to understand if folks are being greedy and putting money in or being fearful and taking it out. Some people just believe momentum's a good indicator. You could probably make an argument for just about every flavor of technical indicator out there being a good indication of fear or greed, and you might just be right. So what do we do with this? Now, Warren Buffett's a people person. He's a fundamentals guy. He cares not only about the basics of the business, but about the basics of the management team. He probably knows when people are being fearful or greedy because they literally tell him they're being fearful or greedy. Good folks at CNN took a stab at putting together a fear and greed index, right, with a couple of different things that we're looking at to try to understand who's being fearful and greedy. So market momentum, stock price strength, stock price breadth, put and call options, market volatility, safe haven demand, and junk bond demand. So you string all this stuff together, and we've got a basic idea of really what may or may not be the right way to think about fear and greed. But the idea is the higher this index is, the more greedy people are being. Lower this index is, the less greedy people are being. So let's think about how we go and test this. What we want to do today is figure out how to test this a little bit. How can we make use of these 7 indicators to figure out if there's something to be done with the market? So the first thing we'll start with here is what is the absolute best that we could possibly do? The theoretically optimal return from the market. Well, let's look at this line with a green arrow pointing to it here. This theoretically optimal return would be if we invested $1 in the S&P 500 index in 2016, and then at the end of every trading day, if we had perfect forward knowledge of what is going to happen the next day, we could go ahead and decide whether we want to be long or whether we want to be short in this particular equity. In this case, it's the S&P 500 index. So every single day, we will be in exactly the correct position. You could do this with a little more granularity. You could go hour by hour, minute by minute, second by second, whatever the interval of information you have available is to probably squeeze some better returns out of it. But as a general baseline of being totally accurate day in, day out of what the market's going to do the next day, this is a good place to start. And one note for later, this includes shorting the S&P 500 index. Our model isn't going to short the index. We're just going to decide whether to be long or out, as a lot of folks won't short the index because it drifts upwards over the long term, right? Shorting a value that's eternally increasing is statistically not a great move, but it may make sense in the short term, and we'll talk about that some other time. So we look at this, right? The very best we can do is to get almost 50 times our money between 2016 and 2024. That's amazing. That is knowing every single day what the market's going to do tomorrow. More realistically, though, if we look at with the blue arrow pointing at this other line, which is simply to put your $1 in an S&P 500 index fund and hold it the entire time. So let's go ahead and get rid of this theoretically optimal range, as no one can ever hit that. So we're now going to look at these two others. We've got buy and hold the S&P 500, as we talked about. And then down below this, we've got the risk-free rate, right? This is where you buy 4-week treasury bonds from the United States government. You're always going to get your money back in your interest unless the U.S. government becomes insolvent. So hopefully that'll never be the case, and these remain the low risk or the risk-free rate of return. Realistically, most strategies that people come up with are going to place them between these two lines, somewhere between the risk-free rate and between the S&P 500 return. What would be exceptional is if we go above the shaded area and find some way to regularly beat the market. That's a pretty cool thing. So let's look at the Fear and Greed Index for a second. Fear and Greed Index is this number that's between 0 and 100. We're going to map it between 2016 and 2024, the same time range we were looking at with the S&P 500. And the way this works is with the values over 50, the market's being greedy. When the value's under 50, it's being fearful, opposite of greedy in this case. 100 is maximum greed, 0 is maximum fear. So how do we turn this into a trading strategy? We're going to start by doing something super simple and just pick these bands, just for illustration here at the 25% and 75% mark. Later on, we're actually going to do a rolling window with some standard deviations out of there, but this illustrates the overall idea. And what we're going to say is, when the index is in this upper band, right, when the whole market is super greedy, our trading strategy is going to decide to be contrary to that, is going to decide to be fearful. In this case, that means we're going to exit our position in the S&P 500 index fund because we're afraid, we're fearful. And when we're in this lower band, the market is fearful, and what we're going to do is we're going to be greedy here and decide to go long on our S&P fund. We're also going to test the opposite of that, which is doing exactly what the market does in both directions. They're greedy, we'll be greedy. They're fearful, we'll be fearful. We're going to go ahead and load the simulation into the magical Kurtosis market simulator. Our first test shows us something very interesting. So what we did here is we set up a rolling window. Basically, it's a moving windowed weighted average of what the Fear and Greed Index is. And we're taking the top 2 and the bottom 2 standard deviations as our thresholds. Functionally equivalent to what we were looking at with that 25-75, but we're doing it on a moving basis so that we're letting the model determine its own thresholds based on what it's seen recently, which is a little more realistic way of doing it for reasons that we'll describe later in talking about modeling. And what we see here is for $1 in 2016, we'd get about $1.14 out in 2024. An additional 14% on our money. That's really not stellar. But that's with the contrarian view, right? We do what Buffett told us. And if we go over here and we do the following the market view, the market following view, we're really not going to do very well at all. So this tells us a couple of things, that namely, The model that we just built using the fear and greed index, using the standard deviations that we used, and using a model that is only long or only out of the position over this time frame is really not a winning strategy. So for the next variation, we're going to go ahead and do the same thing, but with a non-fixed window size. So you'll notice up here, there's a blanked out band at the beginning of this graph, and that's because our window was winding up, was accumulating data to learn what to do as it then transitioned forward. This next one, there's no wind up. So it just starts from day one, accumulating and triggering. And actually the upside's similar and the downside's a bit worse here. We lost money, in fact. So what does this tell us? What this tells us is that it's the answer to a very specific question, which is constructing a trading strategy from 2016 to 24 in the way that we just described, using Warren Buffett's intuition. Can we make money? The answer is yes. Would we make more than the S&P 500? Not the way that we've implemented it. Until next time, take care and keep calculating.